one of the smartest guys in investing history, certainly in our lifetime, is building a lot of cash, and he has a substantial cash hoard right now. When Buffett's building cash like that, I think, no, the market should pay attention. It does tell us that I think the valuations are high.
Hi, and welcome to Wealthion. I'm James Connor. Well, here we are in the month of October, which has historically been a very volatile month, but the markets continue to climb this wall of worry. And it doesn't matter what's happening in the world, in China, the Middle East, or the US, the market just keeps grinding higher and making new all-time highs. Even Nvidia hit a new all-time high earlier this week, and it has a market cap of $3.4 trillion now. But I can't help but think that there's a real sense of complacency setting into this market. To help me make sense of this current environment, my guest today is Jonathan Wellum of ROCKLINC Investment Partners, and ROCKLINC is a Wealthion-endorsed financial advisor for Canadian investors. Jonathan, thank you very much for joining us today. How are things in Toronto?
Not too bad, getting a little cooler, but the colors, the fall colors are beautiful right now. So we're enjoying those for at least the next week or two.
Yes, it's a beautiful time of the year. So, Jonathan, even though you're based in Toronto, much of your portfolio is comprised of U.S. names, so you're well acquainted with the U.S. markets. What's your take on the U.S. economy right now? Do you have any concerns?
Well, the concerns that we've talked about even in the past. First of all, the economy is chugging along. It's amazingly resilient. It's probably one of the most resilient economies in the world, and that's testimony to a very dynamic market and certainly a dynamic economy and dynamic investors down there. Also, I think it's indicative of a lot of deficit spending. And so, as we know, the government is spending on about 6% of GDP or more in terms of its deficit. So debt continues to go up. But overall, it's been very resilient. It's not growing quickly, as we know in the numbers. And there's been lots of adjustments to the employment numbers and so forth. But it has been chugging along, plodding along, better than certainly the European economies, better than the Canadian economy. And as we know, China also, although they're doing a lot of stimulus. So overall, not too bad for the U.S. But we have the same concerns, a lot of deficit spending, massive debt. Where does all this go? These are all structural. It's going to be very difficult to get out of that situation. And they're going to have to, more and more pressure to continue lowering interest rates in order to get the interest costs down and to keep the economy above water.
It's amazing how you can stimulate an economy with a few $1 trillion.
Well, when you have an economy that's 24, 25 trillion, and you're spending, you have a deficit that is around $1 trillion every 3 months, 4 months. Yeah, that's a lot of spending. The other thing is you've got this open border. And so all of the spending, you've got 10, 15, 20 million people, depending on who you're listening to, have come across the border. And you've got all the cities, putting these people up, all the money being spent, flying them all over the country. There's just a lot of stimulus. These are also individuals who can, work for lower wages and so forth and stimulate the market that way. And the U.S. has also, over the last number of years, made major investments in capital initiatives, capital spending. And so their productivity gains are some of the best in the world. So that's also certainly helped their economy, much more so than, say, in Canada, where we're really struggling.
So let's talk about valuations now. And I made mention at the onset that Nvidia hit an all-time high earlier this week. The market cap is $3.4 trillion now. And I want to put this into perspective. This is greater than the market cap of the entire Toronto Stock Exchange, okay, which is around $3 trillion. And how do you feel about the current valuations?
Well, overall, as you know, the S&P, if you take the S&P 500, and of course that does include some real big heavyweights like the Nvidia and Amazon, Apple, and so forth, all the typical suspects, and you're trading about 21, 22 times earnings, which is on the high end of historically what one would expect. And certainly you can't call that a value market. If it was going to be more of a value market, it'd be more like 14, 15, 16 times. It'd be much more appropriate. So the overall market is expensive. But when you look at some of the outliers like Nvidia, clearly that's much higher than 20 times earnings. It's trading more like 40 times revenue. And so from our perspective, We just can't buy a company like that. We don't buy momentum. We don't buy for short periods of time. We're trying to buy based upon the next 3 to 4 or 5 years, and buy it on a discounted cash flow basis and so forth. So companies like Nvidia, in our view, it's an amazing business. It's changing a lot of the market place in terms of its chips and AI and all of that. But we don't invest in companies just for their impact on the market. There ultimately has to be the cash flow that is tangible, that we can see, that we can value. Otherwise, we look elsewhere. And we get the benefit of investing in other companies that are benefiting from AI. And so we actually do own some Amazon, which benefits from the AI. We own Schneider Electric, which is part of the, building the data centers in AI. And even the Brookfield companies are expanding and owning a lot of assets in the AI space. So we don't have to be in Nvidia to benefit from the longer term trends, but we are very, very careful about overpaying and trying to chase stocks just based upon momentum. We leave that up to other people who are much smarter than us at doing that. We're not smart enough to do that. We like to really get down to the brass tacks and being able to value based upon cash flow or asset value, things like that, which matter to us as value investors.
So Q3 numbers are going to start coming out in earnest this week, and we have a number of banks reporting in the U.S. Bank of America, Citi, Morgan Stanley. We also already saw numbers out of Goldman Sachs. They were a beat. And last week we saw numbers out of JP Morgan. The stock popped 5% on the back of their numbers. It's trading at or near all-time highs. It's up 30% on the year. And I was really intrigued by comments out of Jamie Dimon. He said, he was referring to the U.S. consumer, but he said the consumer is fine and is on strong footing. And I guess this kind of threw me for a bit of a loop, because we saw so many companies in Q2 came out and they all cited the fact that they missed their numbers because of a weak consumer. They just weren't spending money. And we saw Home Depot, Nike, Airbnb, Starbucks, and so many other companies come out more, and they all cited like this: the U.S. consumer is just not spending money. What's your takeaway on what's happening with JP Morgan and what's happening with the U.S. consumer?
Yeah, so let's back up a second. I mean, from our perspective, as we've talked about in previous previous interviews, we're not really big fans of the banks in general. So we do not have a lot of exposure. The banks have done well this year with the interest rates settling down and getting the inversion out of the yield curve and so forth. Their margins have been a little bit better, and the write-offs have not been as large as I would have expected. And so overall, the banks this year have done well, but that doesn't change our overall thesis for the next number of years. That we have a very indebted consumer. We have governments that are way overextended, and we have corporations in many cases also that are overextended, and they might even have to, again, as they have to reprice their debt over time. That also is going to be an increasing cost to them. So from our perspective, the big picture is we're cautious on leveraged financials because of the massive amount of debt out there, both on all three levels, the personal, corporate, and government sovereign debt. Having said that, the banks have turned in good solid numbers this year so far, and I think the write-offs are up a little bit. If we are looking at some of the numbers from the consumer banks, there's some pressure on the consumer that we're seeing, and credit card spending is up and so forth. I was a little surprised at Jamie Dimon being as calm and cautious, or calm, and I wouldn't say enthusiastic, but just calm in terms of his comments, and thinking that consumers is reasonably strong. I don't think that's justified by looking at the broader markets and also the consumer discretionary spending, and we'll see. But again, that's the beauty of the market. From our perspective, we can look at other places which have lower risk with also good upside, and we can avoid areas that we think that could develop into future problems. So we're looking ahead, and we're just looking at the overall indebtedness, and we're saying, hey, let's be careful. Fortunately, like in Canada, if you look at the Canadian situation, our biggest position has always been TD Bank for many years. We sold out of our position completely about 2 months ago, a month and a half ago, or 2 months. And we're quite happy to be out of that one. But then that's a specific name that's come under pressure because of the anti-money laundering problem in the U.S. And now there are limited growth opportunities in the U.S. as a result of fines and restrictions. And so we're quite happy to be out of that. But overall, the banks have done better than I would have anticipated, given the stretching of the consumer and the rapid rise in interest rates. And so we're just going to have to see. Sometimes it can be, a lag effect, and it can take a few more quarters. And so we're watching that very closely.
So, and I'm glad you brought up TD Bank. I was going to ask you about that. And so, just to lay the groundwork for our viewers, TD Bank got hit last week on the back of an official ruling out of the SEC. The fine was over $3 billion, number of restrictions on terms of future growth in the U.S., and that's what was driving the growth at TD Bank. And now it's probably the worst performing bank in North America. It's down 8% on the year. So would you not revisit it given the valuations, or do you think there's more to come on the downside?
Yeah, it's a good question. And so, no, we will revisit it. It won't be for a few more months. We'll let things just settle out because our overall view on the banks is neutral at best. And so we're not enthusiastic about it. We're looking at other spaces. But it is setting up for a perfect opportunity to buy a very well-run bank. I mean, obviously, they made a major mistake in a couple of the segments in the U.S. And unfortunately, that can happen with collusion amongst a number of employees. And it was serious. And as we know, if you get into trouble in the States, they'll take you out to the woodshed and really beat you up and extract as much money out of you as possible. But the bigger issue for TD Bank is that they are now limited in growth. They've been slapped. And so from a regulatory point of view, they really can't grow the business in the States now for a couple of years. And that is probably the biggest impact in terms of valuation on the bank, because Canada's already super saturated. As you know, it's already an oligopolistic situation up here. So there's really not a lot of growth in the Canadian marketplace, and everybody's up to their eyeballs in debt anyway in Canada. So expanding their balance sheets in Canada is going to be a trickier business. So that's something, though, that we will be definitely looking at, and there could be a great entry point and opportunity when all the dust settles, and that shouldn't be too far out. And certainly banks learn from their mistakes, and we'll see about that. That could be a great opportunity. Yeah.
I recently spoke with another fellow Canadian, David Rosenberg, and his big concern is one of complacency.
Mm-hmm.
And he's also concerned that many people are too overexposed to equities, especially baby boomers. And he's made mention of the fact that no one does research anymore. They just buy, right? And are you concerned that there's this level of complacency out there? And regardless of what's happening in China, China is maybe imploding, regardless of the hostilities in the Middle East, regardless of what's happening in the U.S. or in this upcoming election, the S&P and the NASDAQ just keep going higher every day. Are you concerned at all about this level of complacency that's out there?
Yeah, no, I mean, David Rosenberg, I think, is an excellent analyst. I followed him from his Merrill Lynch days and keep up with what he is saying. He's a very prudent individual. He's very numbers oriented. He gets right into the nitty gritty, and I like that. And he's prepared to take a contrary position, which I love. And so I do think that he is exactly right. People are complacent, and that's largely because with interest rates being so low up until more recently, you had to sort of look for a dividend. You had to look for that return. You weren't getting it on cash. And so people did go into the market. And we've now had, I mean, other than the COVID situation where the price, the stock market's dropped for a couple of months, but not for very long. We really haven't had a down market in any substantial way since 2010. So, you've got 14, 15 years of a bias to the upside. And there's no question then you get complacency into, being priced in. And so people just start to expect that they're going to get 10% rates of return, 15% rates of return year after year. But as I think David Rosenberg also points out, you've got this massive aging of the population, and you're going to have more and more people living off of some of their investments. And so if they are heavily weighted in equities and there's anything that happens to the equity markets, they come off a little bit, you could get a knee-jerk reaction, more of a knee-jerk reaction because of the allocation to equities is so high that people could come out, and that could certainly cause a larger downdraft in equities. So, I think people need to be careful, and there is a certain degree of complacency. The way we try to get around that is we do own what we hope to be assets that can go up when the market goes down. And so, we have a little bit more in precious metals, certainly a lot more than the average investment advisor or the average Canadian, because we would be running, high teens, maybe 18% of our assets or more exposed to precious metals and some of the commodities, which we think would be somewhat of a hedge over time to a weak stock market. So, yeah.
Jonathan, you're a big follower of Warren Buffett and his style of investing, and he's been raising cash in recent months. What does this tell you? I know you can't really speak for him, but what are your thoughts? You've been following him for a long time. How do you think he's thinking?
Yeah, one of the first people that when I got into the business with Michael Lee Chin back in 1990, Michael said, "Whatever you do, Jonathan, study every single thing you can about Warren Buffett. Read any books that have been written on him and so forth." And I think it was one of the wisest counsels that I ever received early on in my life in the investment business. Warren Buffett is a genius. I mean, this is a man who just has strictly from running a hedge fund to building and then investing and turning that into owning companies, created a business that's worth more than $1 trillion just as an investor. I mean, it's just shocking, his investment performance. And he makes it sound very simple, and he does have very, very simple principles that he adheres to. But the ability to execute on those simple principles is very difficult. The man is a financial genius. And so when he does go in and out of the marketplace, I mean, he typically is a very long-term investor, and so he loves being in the market. But when he starts to build substantial cash positions, I do think you need to take note and certainly process that into your analysis and use that as another data point in how you should be investing. For us, it tells us that one of the smartest guys in investing history, certainly in our lifetime, is building a lot of cash, and he has a substantial cash hoard right now. He's sold down his position in Apple somewhat. Now, that was a massive position he did very well on. He's also sold down substantially his bank positions. And he built some of these big bank positions, as you know, back in 2008, 2009, when he took warrants and supported some of them when they were basically just about ready to go under, bankrupt in the financial crisis, when the government had the TARP program and was spending money to support the market. And so when Buffett's building cash like that, I think, no, the market should pay attention. It does tell us that I think the valuations are high. He wants to have powder dry. And I think it does set him up for a major transaction if there is a downstroke in the marketplace. And that's just the nature of it. I think it's impossible to read it any other way. He sees the market as high, opportunities is not substantial. Particularly, remember, his opportunities have to be big ones too. So he can't buy small cap stocks in any significant manner. He's got to buy medium to larger cap stocks. And so I think he's being very cautious and careful. The selling down of the banks, I think, is very interesting. I think that does tell you that he's concerned about the overall economy and potentially the leverage that's built into the economy, the indebtedness.
And he's been adding to his energy holdings, the big one being Occidental Petroleum.
Yes, exactly, which is, again, more of a commodity, more inflation protection. I think as you know, with the the environmental, social governance, all of the pushing of the green agenda and so forth, making it sound like energy, we're not going to be using oil and gas in the future. That's incredibly naive. We're going to be using oil and gas for decades to come. And therefore, you can actually buy some of these energy companies at 4 or 5 times cash flow. Some of the free cash flow yields on some of these energy companies are as high as 10, 11, 12, 13%. So when you can buy free cash flow yields of that extent versus 0.5% or 1% at Nvidia, would probably even lower than that, then I think a value investor is going to sharpen his pencil and buy some of those assets. Yeah.
And I want to spend a couple of minutes on your investment style at ROCKLINC and how it compares to that with Warren Buffett. And maybe you can just tell us about it and what's your investment style.
Well, we try to use many of the same principles that Warren Buffett utilizes, and that is that we try to look at companies with moats, good protection around them, predictable businesses with a track record that is excellent, in fairly strong long-term growth industries. Try to buy companies, again, that really do produce free cash flow and are good investors in terms of investing back in their business. So they have their own built-in, hurdle rates and things like that. So you can get this natural compounding. And so we try to utilize, strong balance sheets, very defensive businesses, but can grow quickly. So, that's where we try to utilize a similar type of investment philosophy. We're not looking at speculative stocks. We're not looking at junior securities. We're not looking at stocks that have a great idea and might turn out well, but they've already proven by their track record that they know how to make money and they have a cash flow that's coming out of them that we can value, and we don't have to be making wild assumptions in order to justify the valuation of those businesses. So some of our top holdings would include businesses that are in the technology space. So we would have, something like Roper Technologies, which is a major software kind of company, but a lot of industrial software. So it's a leader in a number of different industry verticals. We love that type of business. As you know, the software business is a great cash flow business, reoccurring. You get embedded in people's businesses. You have high retention rates, things like that. Buffett, of course, does not invest in precious metals, and so we would differ with them there. But when we go into the space, we try to go through royalty companies. So they're really investment bankers to the mining businesses. And we like that because they do create a cash flow stream that you can value, and you can look at the counterparty risk in countries that they're in, and build up a comfort zone with the risk profile, things like that. We own some consumer staple businesses, which of course Buffett likes. Companies like Church and Dwight. We've owned Nestle in the past. We've lightened up our position there more recently. And in financials, financials, even though we don't own some of the banks, we also certainly will invest in other financials, like the Brookfield companies, which are infrastructure, but also financial companies, and Burford Capital, which provides litigation finance, things like that. So in all the companies that we're looking at, do they have a long-standing business? Are they run by sharp people? They know how to allocate capital. They're generating free cash flow. We can value them in the marketplace and justify what we're paying for them today. And the future looks pretty bright for them in terms of the industry dynamics and growth opportunities.
You mentioned royalty companies. So what royalty companies do you currently own?
We do have exposure to the big ones, Franco-Nevada, and we've actually started adding a little bit more to it once it got sort of knocked down a little bit because of the trial and tribulation there in Panama with the Cobre mine, where they had the copper mine shut down. But we do own some Franco-Nevada, and Wheaton Precious Metals has been a very, very large holding for us for some time. And Randy Smallwood runs a really beautiful business there, lots of growth and good capital allocator. And Osisko Royalties, and we also have some Sandstorm, which is a very strong company. Their profile, they have a doubling. It's certainly built into their business, a doubling of revenue over the next 5 years. And I think Nolan Watson's positioned that company very well. Even if the price of gold goes sideways, you're going to get a lot of growth in that business over the next few years. So those are some of the major royalty positions that we have.
And how many names would you have in your portfolio?
We like to focus. I mean, one of the things that from our perspective is people often diversify. To use Peter Lynch's old expression, I think he had that in One Up on Wall Street, with a fantastic book he wrote back in the late 80s, early 90s. And so you can be in too many places. That's why we're not big ETF guys and index investing. So we typically have 20 to 25 stocks, with our top 5 or 6 companies being 35 to 40% of the portfolio. So for us, it's all about knowing the companies, researching them, and then having a heavier focus on the companies that we really like, that we think are well positioned and can grow very quickly over the next little while. And we think that's the way that you can outperform and also manage risk, because you understand the businesses really well.
So we both reside in the city of Toronto, so I got to ask you about the Canadian economy now. And the GDP per capita has been in decline now for 5 years. Productivity levels have been declining for 9 or 10 years. What's your take on the Canadian economy?
Yeah, it's in rough shape. I mean, we have had abysmal leadership. I mean, leadership that, again, in all due respect, is incompetent, just grossly incompetent, particularly, well, at the federal and most of our provincial governments too. There are some exceptions, but certainly at the federal level. So how can you expect to grow an economy if you're not incentivizing the investment of capital back into the economy? If you're not rewarding capital to go back in, you're not going to have productivity gains if people aren't investing in capital. And what do our government do? They tie it up in regulations, and then they want to tax it more. I mean, you can't make this stuff up. So it's exactly the opposite of what you do. Then they add more and more taxes. We've taxed energy. So we're an energy producing country. We're one of the largest energy producers in the world. We have the largest reserve, some of the largest reserves in the world, and we're importing energy into our country because we can't get pipelines built across the country so we can move, from east to west and so forth. And then we're putting carbon taxes. So we load up our energy with extra taxes, which then it gets reflected throughout the whole economy. Everything is impacted because everything requires energy. And then you flood, immigrants into the country beyond what we need, by far beyond what we need, who really can't get absorbed into the workplace, and in some cases don't have the skills anyway. And so they're subsidized through the social welfare program that we have, which is under stress. And so then you're going to have, on a per GDP basis, there's no way you can grow the economy very quickly, and then you're taking all the new entrants into the economy. So your GDP per capita is going to fall. I mean, this is not rocket science. So we need a complete overhaul and reversal of the policies in Canada. Absolute 180-degree turn. Lower taxes, lower regulations, energy costs have to get down, stimulate the private sector, take the taxes off capital, and let people invest back in this country. And we need private initiative to take over, and government needs to be slashed. The size of government needs to be cut substantially. Right now in Canada, about 46% of our GDP is government. That needs to be dropped by about 15 to 20% over time, or there's no way we can get out of this. You cannot have the government, the most ineffective, inefficient allocator of capital in the economy, controlling almost half the resources. It just doesn't work. It never has worked. It never will work. And so a lot of our Western countries need to come to grips with these realities, and we need to, again, stimulate the private sector, hold the private sector accountable, make it competitive, and make sure, again, that a rule of law is adhered to. And we could change it dramatically and very quickly in Canada, because it's a rich country, and it's endowed with tremendous assets, both physical assets and also human assets.
And just to provide a little bit of context to our American viewers, the Canadian government, in all their infinite wisdom, imposed 2 new taxes this year alone: capital gains tax and also this carbon tax that you just mentioned. And they did so at a time when people are really hurting economically, right? Mm-hmm. So it was done at the worst possible time.
Well, and a warning to our American friends that are watching this, the Trudeau agenda would be, in my view, very, very closely aligned with the Harris-Walz agenda in the United States. I mean, that's what Kamala Harris has talked about, increasing taxes on so-called rich people. But I mean, basically, as we know, that ends up anybody who's working, and capital taxes, and putting, increase in capital tax, which is crazy. So one of the biggest strengths in the U.S. is lower taxes, lower rates on capital taxes. So you have investment. And of course, when you're making investments, it benefits everybody across the complete continuum of economics. And so a warning to our American friends, be very circumspect and careful when you go into your election next month. I guess it's just 3 weeks away from when we're taping this. There is a sharp difference between the two parties, and certainly from an economics perspective, one will be very much detrimental, similar to what we've seen in Canada.
And you touched on immigration. This has been another big issue, not only in the U.S., but also in Canada. And once again, our government, just to provide a little bit of context for our viewers, they brought 1 million people came into Canada last year, new immigrants. Half of them were I guess you could say, allocated toward the Greater Toronto Area. And we have a population of 5 million people. So our population grew by 10% in 1 year. So you could imagine the tax and how stressed resources were, the education, the healthcare system, infrastructure, and so on.
Yeah, and sort of similar, although I think the situation in Canada has been even worse when you look at the numbers that have come in as a percentage of our base, and certainly the concentration, as you point out, in the Greater Toronto Area or maybe in Vancouver. So there's certain areas where a lot of these new immigrants come, and you don't have the infrastructure. You don't have the schools, you don't have the hospitals, you don't have even the highways to put the cars on to maybe move people around, nor the homes. And so you have this increasing price in the homes. And I think, again, when I'm listening to what's going on in the U.S., and we're fairly knowledgeable because it's bigger than life to us in Canada, what's going on in the U.S. Similar things, increasing costs of housing. It's very difficult, hard to get into, in terms of healthcare costs are also escalating and so on. And that's, again, because we're not assimilating new immigrants at the rate which is healthy, in which, you can actually add to resources, invest back in, these different industries that are required. And so, yeah, I mean, again, you go back to the political decisions that are being made are not positive decisions for anybody, including even some of the new immigrants coming in. I mean, I was just in a cab taxi from the airport a week ago, coming home from a trip, business trip, and I was talking to the gentleman that was driving me, and he was originally from India. And he said he's got friends now that are going back home. They can't afford to live in Canada. And I thought, my goodness, this is something else. So when we hear that more and more, when people come, they think that somehow it's just going to be, the land of milk and honey, and there's going to be all this prosperity. But it's not. It's a tough slug for new people coming into the country and then trying to buy a home or a place to live or rent. Rental costs have doubled in the last 6-7 years. It's very, very difficult and very expensive now to live in our countries.
So there has not been an official election announcement yet, but what do you think is going to happen in the next election? Let's just assume it's in 2025.
Yes, I think that the Liberal Party, the Liberal NDP coalition, has initiated policies that are completely destructive of our country long term in terms of prosperity, freedom, the heavy regulations and so forth. So the standard of living has been going down. So there's no question that Pierre Poilievre, and this is reflected in the polls, I think he's been masterful at getting his message out and also laying out what he would do, which is the opposite of what we see with the Liberal NDP party. So I think that, if there were an election anytime soon, he would win by a landslide. We would see a major change in this country. So between now, though, and when the election looks like it might be called, or it has to be called about a year from now, a lot of things could change. I mean, we've already seen within the Liberal Party itself, a lot of the backbenchers now opposing Trudeau. There's less, they're very concerned about being, of course, not winning the election. So I think we're going to see some changes in the next number of months. I don't know exactly what they are, but when you have a party that's going to go from, a lot of seats down to almost nothing, there's a big incentive on the part of individuals to go after the leader and to try to make a change prior to the election. And so there's going to be a lot of pressure on the Liberals and NDP to make some changes, or they are going to be completely eviscerated in the next election. And of course, I wouldn't mind seeing that, but I think that politics being what it is, I think some cooler minds might be talking to Justin Trudeau and maybe trying to convince him either to change policy, which I don't think he will, or to get out of the way and maybe have a different leader. We'll have to see. It's going to be interesting to watch. A lot of things could be changing in Canada in the next year.
Yes, I'm looking forward to it. Well, Jonathan, that was a great discussion, and I want to thank you for spending time with us today and sharing your thoughts. If someone would like to learn more about you and about your firm, ROCKLINC, where can they go?
Probably the best place to track us down would just be on our website, which is www.rocklink.com. So very easy, rocklink.com. Now, link is with a C, not a K, so LINC. And so you can just go on there, info@rocklink.com. Or you can phone us 905-631-5462, which is actually Link, and talk to anybody. I'm extension 2. You can track me down, but also our business development team. We're here to serve you. We'd love to talk with you. And then as a endorsed financial advisor with Wealthion, we'll free of charge, look at your situation and give you our opinion, and you can take that or you can walk, and you don't have to work with us, but we're more than glad to speak with you and tell you how we would run your money and how we would make some changes to your portfolio and give you a bit of our analysis on that. We'd love to do that. We have quite a few Wealthion listeners have come into us as investors, and they're fantastic people. We love working with them.
Very good, Jonathan. Once again, thank you.
Thank you very much, James.
Well, I hope you enjoyed that discussion with Jonathan Wellum, and it provided you with some insights on what might happen in the coming months in both the U.S. and also Canada. We all need help when it comes to planning and preparing for our financial future. And if you have a financial advisor and you're happy with them, then great, stick with them. But if you don't, or maybe you want another opinion, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com/free. It's a free service that Wealthion offers to anyone who has an interest. You can find out more information at wealthion.com/free. And if you like this content, please subscribe, like, and share. And now you can check out this next video.